So this is a guide for taxation in Uganda. So here we have two. We are looking at taxation and the handbook that you have. The handbook that I have shared with you will show you the detail of how taxation in Uganda actually is done. You will see the history of taxation, that taxes in Uganda began uh, by compulsory public work. People would be subjected to public work without pay, so that public services go on, relying on the labor of people. So until it went to this gun and hard tax, which you really saw that if you had a house and there is a man there, that one needed to pay taxes, and those who were there those years, they would see men running to hide away from the tax man. So you needed to have a ticket to prove that you've been paying taxes. So the tax regime called graduated tax came in until it was transformed into what we call income tax, and then this is the customs tax. Income tax is charged by end of year. You've got to show what you have, your incomes versus expenditures and other costs, then the net profit. That net profit is what they use to compute income tax here. Income tax is of two kinds. There is income tax for individuals, that is a person as one, but there is also income tax for corporate entities. Those are organizations such as a company. So they call it, that is income tax for non-individuals. So here there is also another provision for customs duties. When do we say this is a customs duty? When do we charge customs duties? When do we collect customs duties? So we collect customs duties from what? From imports. And exports. So customs duties, those are taxes on borders, cross-border taxes. Goods are coming into the country and goods are also leaving the country. So you will see later on that we have customs duties, but we also have domestic taxes. Domestic taxes, which are collected within the country, and the customs duties are collected across borders or trans-border trade. So the body that is responsible for collecting taxes so far in Uganda is the Uganda Revenue Authority, and this is operating under the Ministry of what? Finance Planning and Economic Development. So it's the tax collecting body, but it is collecting taxes on behalf of the Ministry of Finance Planning and Economic Development. So this one is led by the Commissioner General. The Commissioner General in charge of URA that reports to the Ministry of Finance or the Minister responsible for finance. And the money they collect is from taxes is deposited in the government treasury, which is managed by Bank of Uganda. So wherever money is paid, whether by mobile money or by bank or any fintech, those pay, they call them what? Payway, yeah. The money is deposited with Bank of Uganda in what they call the consolidated finance account, or the consolidated account of Bank of Uganda. And then the Ministry of Finance now gets the money from there to distribute it across the various departments of government for investments and expenditure. So there you will see the history of taxation in Uganda. But this is very key for you to look at principles of taxation, which ranges from equity, that taxes should be equitable and fair. If taxes are levied on a person who cannot actually unjustly, simply because one wants to get money from you, but the taxes you charged don't match with what you should actually pay, then we say that the taxes are not equitable, or there is no equity and the principle of fairness. So they should be matching with your incomes or matching with the business's capacity to pay. So you also see here convenience. Convenience, that is when you are to pay your taxes. It should be convenient. Just imagine if people are told you go and pay money physically, you line up in one of the banks that is selected in the country to be able to pay your taxes. Possibly it would be hard for somebody to travel from Lira to come to Kampala, because that's where the branch is, to pay taxes. Such kinds of payment is not convenient, so it is inconveniencing. So there should be convenience to pay, convenience to file returns, convenience to access. There should be, even in the of time of payment, the mode of payment, the place, all that is in that what we call the principle of convenience. So here, the principle of certainty is where you say one has got to understand what type of tax, how that tax is collected, how the tax is calculated, and then also uh, how the tax is paid and when the time of payment, so that we are certain, we are aware. That's why Uganda Revenue Authority is supposed to document uh, how to calculate taxes, how taxes are calculated, and also to, to train people on how to handle such taxes, and then create awareness that there is a system that has been brought in place, such as that of IFRIS, the electronic fiscal receipting and invoicing solution. IFRIS, that was brought to collect taxes of value added tax. It has got to be known by people, and thus it should also be based on the tax laws that have been passed, because any tax that is imposed and it is against the laws, it is null and void, so cannot be accepted. For the case of Uganda, we have what we call the Domestic Tax Act, which shows how taxes should be collected within the country, and which type of taxes should be collected. That is an act of parliament. It is a law. And it would be good if an entrepreneurship teacher or anybody involved in business read the Domestic Tax Act, then also the Customs Act, the Customs Act, which shows how taxes are collected across borders or for imports, exports, and what rates are considered for each type of goods, or category of goods. So here is awareness. People must know uh, what kind of tax they are expected to pay, and when is it collected, and how is it computed, who is the collector of that tax. So that what is required, what's the process. If it is not, it is not certain, and the day comes and people just see their businesses are being closed, they ask which kind of tax, they don't know about it, then that is uncertain. Then economical here is that the taxes have got to be as low as possible to enable the taxpayer or any afford such taxes. So should match with the incomes of people, and then it should be within affordable costs. Those are, so you will see that those rates are set with that consideration. Like tax on mobile money, that was 1%. People had to complain that 1% was so big because it was not economical, so it was reduced to 0.5%. But again, you have got to keep monitoring to see whether that is 0.5% is still economical. Otherwise, people can demonstrate, and also taxes can result into losses. Then simplicity, this one you will see that the process and the method of assessing taxes. Assessing is how do you arrive at what to pay. If it requires a lot of calculation, you spend that day calculating to arrive at how much you should pay, then that is not simple. Or the process is so long, then it is not simple. So in paying taxes, there should be simplicity, so that complicated taxes can lead to disputes. People can disagree, delays, corruption, avoidance, and high costs of collection, which makes it very hard for. You will also look at other tax what principles which other countries can consider. That is ability to pay. Ability to pay. There is a year that was 2022 when URA raised an assessment, like a liability on my account, over 42 million shillings, and they took over my account. And now 42 million shillings was a very big tax burden for me. I had no option. So if the tax is to be assessed or levied, it should not exceed a person's income. If it exceeds a person's income, then that person has to borrow to be able to pay taxes. So he will not eat, will not develop, because he is paying taxes. Yet taxes have got to be paid in such a way that people increase in productivity at the same time as they are what? Paying the taxes. So these ones, you will see the characteristics of a good tax system, that should be progressive, that as you increase on income, you also Also, the tax rate should do what? Increase, because your income is big. Then also there is also what they call regulation taxes. So regulation tax, regulation, a tax. This is the regulation, the tax based on regressive uh, uh, principle. It is like when it is structured and like your income is too big and the percentage is, for example, the percentage is 5% on a person who is earning 10 million. That person will be also experiencing a very big burden to pay because he's earning big money. So the tax rate has got to be with at least modulated to make sure that this person who is also earning big money does not become another problem of earning big. If you are charged big money because you're earning big, you feel like I should. Mm. Thus, in a regulation, the tax rate decreases as the income of the person increases. Otherwise, people who earn big money will start to avoid paying taxes because they are going to lose to remit a lot of money to the government. But at least it should be fair. Hmm? If it does not follow this regulation and the tax rate is big and they are earning big money, they, it, the government the government has the ability to see how much you earn, provided you are a formal worker working in a registered system. Like if I earn the money, when they pay, they also file a return showing how much they have paid to me. So the government can keep adding up how much I've earned 12 months. Even non-government workers are taxed because the private companies are supposed to be tax registered. If you have a company, it can be you register for taxes and get what they call a TIN, a tax identification number. So if you have like a retail business and you've not registered for taxes, you don't have a TIN, then it means that Uganda Revenue Authority, the tax body, is going to come to your shop and assess you, calculate, try to estimate how much tax you could pay. That is called a presumptive tax regime. Presumptive tax. They presume how much you should pay. So sometimes people find it very, very costly for them when they assess them based on assumption. That's why they encourage people to register for taxes, even if you are running a retail, so that you file a return every end of the year, what we call the income tax return, showing how much you've collect and what expenses you have made, and then what was the profit or loss. If you've made a loss, you don't pay taxes for income tax. When you make a profit, they compute 30% of that what that profit goes to government. Then the other remaining portion, you can now reinvest it, or you can go and enjoy whatever you want. Sorry? Hmm. No, the tax, that's why you see the tax is progressive now. And when you make profit of, say, 1 million a year, and then you are to pay 300,000 to the government. If you make for if your business grows in profitability at 3 million, you still pay 30%, but of 3 million, which is about 900,000 shillings. So it is, you grow, when your business grows, you're becoming of more relevance to the country, so you contribute more tax. Yeah. Yeah. So proportional tax, that is when uh, the tax the tax rates uh, remain fixed regardless of the tax base, meaning regardless of where the tax is coming from. It is fixed. That is proportion. And usually proportional and progressive is used. Even this one, in some cases, regressive tax is also used in some cases. So proportional tax is mostly also used in what? In customs tax collections. Now you will see the these are roles of the taxpayers' obligations and rights. You will look at the taxpayers' obligations and rights, uh, the taxpayers' rights, yeah, the right to fair treatment, that is corresponding to the principle of fairness and equity. So when you go to any URA office, uh, they should not say, the way we are seeing you've come in gumboots, you sit down, or keep standing there. Their seats, everyone should sit there, because you are a taxpayer who has got to be treated fairly in all dealings of Uganda Revenue Authority. Then this is raised to finality. Now, when URA takes a decision for a year or two, so for what should be paid, one should know the time, the maximum time when he or she is granted to express a dissatisfaction. And then should also know, if it is an audit, URA has the right to come and audit your firm. Should it come every day or every year? Of course, in some big companies, URA sends a staff to come and sit in that company to oversee operations. so that you don't evade taxes, and also support you in collecting taxes. But in some smaller businesses, URA assigns the staff, but the staff does not sit in what? In your business. But those large companies which are dealing in production and they want to monitor excise duties over how much have you produced, the person has got to sit there. But when URA, for example, takes a decision and says you have to pay 70 million shillings, okay, and you feel like you are supposed to pay 1 million, the person has got to, you've got to show when should the person actually challenge the decision that URA has taken. Should it be 1 month? Should it be 30 days or 60 days? Recently, it has been 45 days. When they impose what they call an assessment, where they come up and say, according to what we see, 300 million is what you should pay. And for you, you thought it would be 15 million. You're given 45 days to challenge the decision that URA has imposed in what they call a tax appeal. You appeal to URA that the assessment was not appropriate and was unjust. Then they listen to you. You have to produce documents to prove your position, as they are also proving to you with the data they have. The right to privacy, when you are like checks your accounts and sees how much you earn, and then you've made inquiries and there's some information you have openly shared with URA, that information should not be shared with anybody or used in 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 accusing you over some matters. So there should be that privacy or secrecy. This is confidentiality. Yeah, that confidentiality. You have to keep information this undisclosed unless authorized by the taxpayer. So you can't go and log in another person's account and start to look at how much tax they are paying. You should have the right to their TIN. They share with you the password and then the TIN itself, that account, so that you log in. So I recently heard that URA is preparing to make sure that everybody who has a national ID, that ID number becomes the TIN for paying taxes. So provided they have issued you with a national ID, then you already have a tax paying number, a tax identification number, other than giving you a TIN, yet you have a NINI, national identification number. For far it is being processed. There is also the right to be informed. That one corresponds to which principle? But everything here that the person should know, the taxpayer must be informed, should be given explanation, should be given procedures, should have forms and instructions on how he or she has to handle taxes. That corresponds to the principle of certainty. This is the right to timely and quality professional services. So these services have got to be from URA, they have got to be timely, on time, quality, and professional. That's when the person is dealing with URA. You look at other rights, that rights to representation, like one can appoint another person. If I can't handle my tax matters, I can appoint another person who could be an agent or a clearing agent to handle tax issues which are related to, for example, clearing and forwarding, to handle them on my behalf. So it does not mean that in my absence, then handling my tax issues is standardized or paralyzed. So there you'll have the right to representation. You could also appoint another person in writing that person represent you in URA over an issue. If there is an issue you can't handle, you can appoint a person to represent you. For that person to be represented, to represent you, your company, or you as an individual, you've got to write appointing that person and giving the person the right to access your information, because URA cannot just give information or listen to anybody acting on behalf of another without authorization. These are right to challenge or object. So what do we call an objection? If there is an assessment, like they call it additional assessment, URA comes up and says, but according to what we see, you, the action entrepreneurs, you pay 300,000 shillings. And then they put an assessment on your account and they really press you to pay. So there is what they call a right to challenge or object. There you reject a decision. You have got to, these days you file a return called an objection return. In earlier years we would write to URA to object, to reject. You use the word objection, that the tax assessment, the amount that was assessed was not right and true, and therefore you seek to be heard or listened to, and that is, they hold a meeting which you agree with each other. They call it a tribunal. Tribunals, you listen to each other, challenge each other until you come up with what? A conclusion. These are now rights to appeal. Now, when that objection tribunal, that like a smaller court where you sit and start to argue, you don't resolve, or they resolve it not in your favor, you again appeal. An appeal is like you can now apply for another independent tax tribunal, or it's called a court, so that you still seek to challenge further than the first one. If the matters don't go right, you can appeal up to the what they call the High Court. The High Court makes the final decision, because some of the assessments which the URA raises money to people could be in billions of shillings, that if you do not go through the laws to challenge, the company can fall because of the tax burden. Yet URA has the right to come and auction machines, land, and assets that you have to recover a claim, a tax claim, or a tax liability is holding to you. So if you don't go through the courts or these tribunals, you stand uh, you stand to lose. That's why some companies can have lawyers. But here it is a lawyer versus a county, a finance office, and then the government. So you're going to look at also obligations of the taxpayer. For example, taxpayers have got to register for taxes and get a TIN. That is an obligation. In some countries, if you don't have a TIN, you're not allowed to travel or get involved in trade on production. But here, we allow informal trade and informal production to some extent. Then you have the right to refund claims. In case there is money that URA has withheld from you, you can claim for it, and then URA pays it back to your account. There is what they call withholding tax. You will hear it. Withholding tax so far is 6%. It is charged on professional services, so they charge you 6%. They withhold that money for you, but you can claim for it, and then it is repaid to you. URA uses it to monitor people who are consultants, those who are in professional services, so that they know that URA is monitoring their what? Their incomes. So if you declare to URA the money you have had, yet has been withholding some money from your incomes somewhere from your clients, then you stand to be penalized. So it uses that to watch. Even those who pay VAT, you will see how we calculate VAT, that you can claim for money from URA on VAT, and URA pays you that money back to you. Like though there is also what they call it is called diplomatic VAT, where foreigners, when they are coming to Uganda, wherever they buy goods, they keep asking for an invoice so that VAT they are paying there, at the time of exit, they claim for that VAT from URA and it is paid back to them on what they call a claim. However, when it is a business operating in Uganda, claims, for example, for VAT, they say that you have got to have accumulated money with URA over 15 millions and above for you to claim for it. If it is below that, yeah, you keep it with URA, and when you get a liability to pay, they keep reducing it in compensation with what you owe. There. So keeping proper records. So companies have got to keep these proper records. Any receipt that you have sold, you have a record. Any expense that you make, you have a record. So that people don't overstate. We call it overstating expenditure. You say you paid the electricity, 25 million. Show us the invoice that URA gave. Sorry, Umeme, these days it is Uganda Electricity Distribution Company Limited. That UCD CL gave you to prove that you were right to spend that money. Otherwise, people would just say, let us put a lot of expenditure so that we pay little taxes. If you say you paid the workers' salary, then you have to prove that those workers signed for it, and that is also not enough, that you also filed it in your pay as you earn return, that is the money they were supposed to be paid. So some companies here in records, they declare sales. You sell 200 million shillings, but again you show URA that you have sold 80. But the URA now, that's why for VAT, they are saying put all your stock on our website. So URA has a portal where you load all your stock. Whichever you sell every minute, that stock keeps on reducing. So they are able to see your sales, to watch them day by day in what they call electronic physical receipting and invoicing solution, IFRIS. Because people were under declaring sales. That's why even when the traders in Kampala demonstrated and called the president, he was very reluctant to listen to them, because it was one way of avoiding those people who under declare what? Sales. When you purchase, you declare what you've purchased and from who. Then the one you declare that he has sold it to you also has to declare that he has made that as a sale. To you it is a purchase, the other one is a sale. So now you show that you have purchased, but the other one is not showing that he has sold. Then you can raise an assessment to him for under declaring sales. Why? URA will show you sold it to this one. You see this record? How comes for you you are not showing that you have sold it to him? This one showing that he purchased, yet for you you're showing that you didn't sell to him. So that is keeping records. That's why you find businesses have got to have invoices, receipts, payment vouchers, and audited books of accounts kept every year. They show the law indicates for record keeping that a business has got to keep records for at most 10 years before disposing them of. So if you have payment vouchers, you keep them for 10 years. After 10 years, then you can now dispose them of or archive them somewhere else. Then filing a return. There is filing a return shows this return has got to be filed every specific period. What they call a return, I'm going to show what they call a return. But a return is a file which is programmed by URA, where you enter data and then it gives you how much you should pay according to the rates and the amounts you have entered there. But the tax rates are regulated by URA and they are standard. Every financial year, they keep on revising these rates. So when they revise, they update the file, which we call it is, so far we are using Excel. It is programmed Excel, where you enter and it automatically calculates for you. But there are times the returns have to be submitted timely. For example, examples of taxes, you will see a tax such as pay as you earn, that is a monthly tax. So for it, you've got to file it every end of month. For example, a pay as you earn return for the month of March has got to be filed at the end of March, like 1st of March up to the 15th day of the new month. That is up to 15th of April. When 15th of April reaches and you have not filed and becomes the 16th midnight, you have a penalty of 200,000 shillings. It is called non-filing penalty. But sometimes when that situation comes and it reaches that time you don't have data to file to URA, there are two options. One, you file a nil return. You get a file and don't put there anything like data, and then file it as if it is a what? A finished return. So URA receives it that you have filed, for the system to know that you have complied. So that is called a nil return, or other people call it a zero return. But again, the other way is to apply for an extension of filing date. That is also provided for on the portal. But if you had applied for an extension, then you should have filed for it earlier, like 1 day before, so that URA officials see that you have applied for an extension of filing date and they approve it. If they don't approve it and the date goes beyond the 15th of the new month, you get that penalty. If it is now that monthly returns such as pay as you earn, VAT, returns such as, those are monthly returns. VAT individual, VAT corporate, pay as you earn individual, pay as you earn corporate. So all those are what? Monthly returns. But there are also returns which are annual, such as taxes, such as income tax. Those are annual. You've got to file them. For annual returns, like when the year closes 31st December, no. The government works in what we call financial years. The financial year begins in which month? The financial year starts on 1st July and it closes on 30th June. Okay. Now, when 30th June comes, the new financial year starts the following year. So, now, 30th June, when 30th June ends, in the new financial year, they give you a time of 30 days to file a return of that past financial year, so that you can prepare your transactions for correct data. They give you 6 months. So when it comes to, 30th June is the middle of the year. So 6 months end on 31st December. That's when you're expected to file the income tax for that year. Then there is also what they call payment of taxes. When you file a return and there is a liability, what they call tax obligation, a liability to be paid, then you have got to pay it. If you don't pay, they compute every day that passes a percentage of interest for not paying. So many taxpayers, there is a year when an accountant did not pay 200,000 shillings, and there past 6 years. By the time we checked, you had raised interest of 4 million, and they wanted us to pay 4 million shillings because of interest. They assumed that because you are not paying it, then you are investing it. So let us share the profit in what they call interest. Then there is also avoid tax evasions. You've heard of people who smuggle goods. They smuggle goods across borders because they want to evade the taxes. That is also an obligation. Then there is also this one called the compliance with the tax laws. You've got to obey what the law says and do accordingly. Follow the processes provided. Then update personal information. That is also an obligation. You changed from one place of business to another place, but when you changed, you didn't go to URA portal and change the location. So when URA is looking for you, they drive their cars and come to a place you left 2 years back. Or the telephones you changed, but you didn't change on the portal. So wherever they call, no one picks or they are off. That's information. So due diligence in tax matters, that is now a taxpayer. In case you delegated a person to deal with your taxes, that person makes errors or mistakes, it is you, not that person. Then also being respectful to your staff, that is okay, because I pay taxes. So what are you saying? We are the ones who even buy your cars. Those words there, taxpayers use. So there is also respect there. Dealing with authorized staff, that is okay. The person should prove that is working with URA or is an agent working with URA. Then also quoting your TIN on all documents. Like if you're registered with taxes, you've got your receipt should have a TIN. Your invoices should carry a TIN. When you're logging into the portal, you use the TIN. When you're going to report anything to URA, you go with your TIN. You don't forget it. So the need for an interpreter. In case you don't understand the English language, and the people possibly are using the English language there in URA, you can go with an interpreter. You have that. The person to tell you now they have said. And this is e-tax. E-tax is available where you can online register for a TIN. Online you can also file the return. Online you can make a payment on a return and run reports there. Now let us look at the taxes that is taxes. We call them domestic taxes. Yes. Okay. Now, in case a business collapses or you close business, now there are two taxpayer types here. We have individual and non-individual. A company or an NGO is or a partnership, all those are non-individual. But sole proprietorship businesses are individual businesses. Okay. For the case of a sole proprietor who has an individual TIN, you have a TIN for you. You are said even if you register the business, when it is sole proprietorship business, you get at your personal TIN is the one that works for that business, because it is you, even if the business was given a name which they call a business name. For that case, when that business collapses and you no longer make money, you file that you are no longer making money. You continue to file returns zero. that you're not selling and you're not spending. You file, but you must file a return end of year for income tax for your case. In case it is pay as you earn, you file a nil return. Provided you have started to file, you file a nil return. You put there 0, that you are not paying any salary. Reason being, you closed the business, but you cannot close out an individual business. You can close a business name, but your person, you can't close it out. Like when you get your team, you can't reach at a time and say, now my team is not, you close it out, because it is you. It's like saying you close out my national ID, yet you're still living. It is until you have died, that's when that thing becomes closed out. An individual thing cannot be delegated, because everyone should have his own national ID. It's like a national ID. You can't pass on and say that my national ID be with my hair, be owned by my hair. So that's the same with individual businesses. But if it is a company where the team of the company is different from that of the what? Individual directors of the company, and the company actually does not do well and you close it. Companies are not closed like people's individual businesses. There is a procedure for closing companies, which is specified in the what? In the what we call the Companies Act, and also the Insolvency Act. Insolvency Act. Insolvency means the company has become bankrupt. So for that case where the company has become bankrupt, for you to close out the team, you must have to apply for bankruptcy. How do you do that? Bankrupt businesses, you've got to fight to 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 they call it you go to the high court and open a case that your company cannot afford to live, therefore it should close. You've opened the case. So the government appoints a lawyer to challenge your position. You have got to table your books of accounts showing that your company is making losses and therefore it cannot operate anymore, until the high court judge resolves that that company really has to close. When it declares that the company has to close, they appoint what they call a receiver. A receiver is receivers for ordinary businesses, ordinary companies, is the Uganda Registration Service Bureau, which sets up management to manage a dying company. Now, that is called statutory management. The government starts to manage the company so that it dies well. It shouldn't die and leave people suffering. So what they do, they set up a manager to help the company close well, and then they also appoint another person called a liquidator. The liquidator is responsible for selling off all the assets of the company. and recover some money to pay back the creditors of the company. Those creditors could be staff, could be suppliers, could be service providers. So they pay them according to what has remained. Why? Because this is a limited company. All the liabilities of the company don't spread to the directors, but instead the company itself should pay from its assets, should pay its liabilities. So when they sell off all the assets, the money that is collected by the liquidator is proportionally by percentage of who has the biggest liability. 20% you get, 2% you get. If you were demanding 25 million and what has been collected by percentage, you should be paid 30,000, you get that 30,000 and part away with that, because that is what is available. So that is how then after closing it entirely, then you use the court decision to present it to URA that this company is no longer existing. The High Court closed it, and this is the proof. Then URA can declare that tin, the company is no longer existing and it is closed. They withdraw it and inactivate the tin. You see the process. But for individual businesses, you close it, but you continue. You've just closed an operation there, but you yourself, you can't close yourself. So here, these are some of the domestic taxes. If one is to file returns, these are some of the domestic taxes. Income tax. What is income tax? Okay. Income tax is a tax that is charged on people's in businesses or individuals. Income tax can be business or can also be individual tax. If it is individual, an individual business, that's why here there is indicate an individual taxpayer, or it can also be a corporate non-individual taxpayer. By the way, very few people know that if you're filing pay as you earn and the companies are filing for you and you have a team, you as an individual supposed to file an income tax, summing up all that pay as you earn that you have earned. Okay, the summing up all the net salaries you have earned throughout the year, then take away all your personal expenses for the year and file it to URA. So the resultant tax is called the income tax. But then you can net off, you can knock off what you have paid as pay as you earn, so that you don't, the double taxation does not happen. You're paying income tax at the same time paying pay as you earn. But that is very important. So companies can pay as individuals income tax, but also persons can also pay. So VAT is charged. Maybe what we've not mentioned about income tax, this is a year, an annual return. However, companies can also apply to file in 3 months, 6 months, 9 and 12 months. It is annual. It can also be quarterly. But that system, you've got to inform URA that we are having a quarterly system of filing our income tax, or we are having a semi-annual system, or we are having a 3/4, or we are having a 12, or a full annual or annual return. Usually for us, we use 1 year for 12 months. So we usually, when we file it, end of financial year, we spend 6 months preparing, and then by 31st of December, we are filing it for the previous financial year, which closed by 30th June. 30th June. Then here, VAT. You've had VAT. This is a trading, it is a trading what? Tax. Charged on goods at purchasing and also while selling. The tax rate for Uganda is what? For VAT. The standard tax rate is 18%. So it is charged on sales. It is also charged on purchases and expenses. We shall see where sales are outputs, output VAT. Purchases and expenses are input VAT. Then we shall also look at what we call inclusive tax and exclusive. Inclusive goods, tax inclusive goods, and tax exclusive goods when it comes to VAT. So this is a monthly return. VAT, every end of the month, VAT registered companies or organizations or individuals have got to file their return. That file that tells URA that this is what we have sold, this is what we have purchased, and these are our expenses which had the VAT. That VAT return has got to show that. So end of month, for you to file, the deadline is in the new month. You file the previous, the VAT return for the previous month. You should not exceed 15 days in the new month. These are the ones they show you, which they say by the 15th day of the following month. This is gaming tax. Usually this is charged on those who are registered in gaming. There's a national gaming and the lottery law, and there's the gaming and the pool betting tax. Those who are involved in games and betting, there's that tax. Pay as you earn. You have got to register all the employees so that each of them has a team, and then you've got to declare how much you're paying them every month so that they charge according to how much each person earns. Pay as you earn. So that return is a monthly return. You should also file it within the first 15 days of the month, of the new month. If you are filing the previously closed month, that's pay as you earn. So in pay as you earn here, we shall see that for us to compute our pay as you earn, we shall know how much is the basic pay, then how much is the allowances. So basic pay plus allowances equal to gross pay. Then we shall look through the schedules and see how we can actually pay the tax schedules. URA has a schedule for pay as you earn, which shows you which ranges and which tax rate you apply for people falling in that range, which many people call brackets. We shall see that. So gross pay, we shall see gross pay, take away pay as you earn, a person receives the net pay. We shall compute that. These are excise duties. Excise duties are they are duties for those who are producing goods and services. So far, excise duties are at 15%. They used to be 10%, they increased by 5%. So if you're producing goods, the cost of production, you're producing bread, and the cost of production of that bread, those bread is 200 million, you compute 15% of that and pay it to URA for producing those goods. Even services in banks, they charge on deposit 15%, sorry, on withdrawals a 15% excise duty. So there happens that excise duty thing. But in production, every producing company of manufacturer faces this tax called excise duty. Some students call it exercise duty, but it's excise. So what you have produced, total of what you have produced that month, what is its value, then they compute 15% on the total value of production, cost of production. Then there are also others. So far, that is those are the taxes, or which we, in domestic taxes, local, we shall look at in there. We shall see how to compute VAT, pay as you earn, how to compute income tax. These other ones you'll be able to compute them.